out to your FX and crypto midweek for July 12th. Sorry for just a couple of minutes late start. I had to reboot, some sort of issue with GoTo reinstalling or doing some sort of update. But we're ready to rock and roll here. Let's jump into a couple of things. So I'm going to take a little bit different view.
Do you want to be a professional trader? Maverick Currencies is the oldest US-based Forex and crypto prop trading company that will pay you for trading with our capital. Trade our capital and keep 70 to 80% of the profits. We are looking for traders just like you that are hardworking and motivated. Click the apply link on the top right of this video to see if you have what it takes. That link takes you to a 4-minute video that explains the trader position available, and you read a list of FAQs that answer pretty much all the basic questions you have at this point. After watching the video and reading the FAQs, if you're interested, fill out an application, then you'll watch the full-length recruiting video, and then schedule an interview with one of our traders. Are you our next trader?
When a day like today happens and there's a pivotal turn, sometimes it's good to just come live into the markets and explore that together, dissect it, analyze it, talk about risk, reward, probabilities, and so forth. And so what we're seeing in the bond market is important, I think. So remember that bond prices have been going down, which means what? Interest rates have been going up. They move inverse to each other, right? If bond prices are going down, then rates are going up. And I think we're in a transitional phase. I think we're in the transitional phase where everyone was worried about inflation, and now we're moving to where rates are going to become the bigger issue, right? And we're in this process. Now, it's a drawn-out process, but every single day in the markets, rates are becoming an issue. Let me explain. Corporations borrow money. Governments borrow money. Of course, consumers, you and I, will at times borrow money. The rate that you're paying compared to your prior borrows is getting worse and worse, and significantly so. This is not a minor change. This is a more major change. And so this transition where as bond prices are falling, what it really tells you about is that rates are rising dramatically. So if we come over to Forex Factory, and in fact, let's click on the calendar button, and then we can come down here in the corner and see central bank rates. Just look at in the US and look at this chart. I mean, this chart, sometimes a picture says a whole lot more than words. Look at that picture. What have rates done in the last calendar year? They've been going sharply higher. I mean, we've had a more dramatic rate increase in the US and really around the world than ever before in history in such a short period of time. Part of that was the Fed's stupidity, right? The whole debacle that was inflation is transitory and so forth. But nevertheless, we've seen a dramatic change. So let's say that XYZ Corporation has borrowed $1 billion in the past. There will be a maturity date on that $1 billion, meaning they have to repay that money. And let's say that that money is coming due in September of 2023, in August of 2020, maybe July of 2023. What do? Well, they probably don't have $1 billion sitting there in cash ready to pay. What corporations are going to do is roll out that debt to a new bond. In other words, they're going to go sell another bond and raise $1 billion to essentially pay off the old one, right? And here's the issue. By rolling out that debt, maybe they were able to pay 3% or whatever over here. Now it might be 6%. Maybe their interest costs have doubled. And that's pretty darn significant. And that's happening to corporations around the world. Let's look at the consumer. Let's say that somebody has a car loan or whatever, right? And they want to go purchase a new vehicle. And they've paid off their old loan that only cost them 4% a year or whatever, I don't know. And I don't have car loans and things, so I'm not even sure what the exact rates are. But this car, they paid 4% or whatever. Well, now they're getting a new car and maybe it's 7%. It's real, right? They're buying a house. The mortgage used to cost 3.5%. Well, now it's 7%. It's double the cost. And so this is happening literally every single day in the markets. Now, it's not a problem until it becomes a problem, but this is what we call credit. And this is what we call, expense of that credit. And credit conditions are hugely important to asset prices. And I think this is an important turn. It's an important turn because of where we're at in the cycle. Economic cycles, whenever you look at an economic cycle chart, it always shows it like this, which can be a little misleading. They'll say, okay, you go through a recession, and then you come into early stage growth, right? You just start to come out of it. And then this is the middle, and this is the late cycle, and then you go back into a slowdown, and then the recessionary numbers hit again, and then you come out of that, and you have an early stage recovery, then you're in the middle portion of that growth phase, and then your late cycle, and then you go back into, and these cycles happen over and over and over again, right? If you look at the history, there's recessions. There was a recession. It was a very short-lived recession, but there was a recession in 2020. And if we went back a little further, 2008, 2009, there was a recession area here. And you go back to 2000, 2002, there's a recession. Well, what this cycle doesn't tell you is how long it will last, because each one of these cycles lasts different time periods, right? It would be very nice if every cycle lasted exactly X number of years and you could just mark it on your calendar and you could say, okay, well, now we're going into this. Oh, boy, wouldn't that be easy? Markets aren't that easy. Sometimes the growth phase is 12 years. Sometimes it's 3 years. Sometimes the recession lasts 2 years. Sometimes it's 4. It's hard to know exactly how long it's going to be and so forth, but we've got to look at the entirety and make an assessment. And as you know, I pounded the table. I made a joke earlier this year that you would get tired of me saying the markets are good, the markets are strong, they're bullish, but watch for us to move into the exhaustion phase. Watch for those characteristics when we get there, because that was going to be an important time in your life for the next couple of years, planning out how things are going to go from that standpoint. And so I tried to really emphasize, look, stocks are in a good place and they're fine. And I said that for the entirety of this run. I became bullish on the markets back here before it was beloved, certainly. I don't know exactly where we became quite bullish, but it was certainly back here months ago. Remained bullish, said watch for the exhaustions. Got more cautious in here because we started to, not cautious in the very short term. We kind of said, look, it's more likely to go up a little bit more in the short term, but be a little careful because now we're entering that exhaustion phase. And do I still believe we're in the exhaustive phase? I do. We've gone sideways for the past few weeks, and today we broke to new highs. So do we trust it? Is it just, hey, take risk, it's risk on, everything's going to go blasting higher? Maybe it is, but that's not, that would be weird to me that would be the case. What generally happens, and this is news driven, why did the markets gap up sharply today? And if we're at a peak here, in markets, right? If we kind of think about the growth in the markets and we were to just draw the stock market, we're kind of at a new high for the past few months. Is that a new high that you want to rush in to buy? Or is that a new high that you say it's a sucker's rally, it's going to be a false breakout, you're going to have a reversal and so forth? And we have to make that assessment. We've got to decide today what we think this is. Now, technically speaking, from a chart perspective, it looks okay because although you had exhaustion signals, you worked off some of that exhaustion. Now we're trying to break out again. So technicals, I'm going to have to give it to the bulls. I'm going to have to say it does appear more bullish for now. But fundamentals, I'm still of the camp that what the Fed is doing is going to have an impact. It's just these things take time. It's as the Fed started to hike rates, it just wasn't that big a deal because it wasn't like all that money came due. But all that money that's been borrowed, it will come due. It just takes time, right? Consumers will borrow at higher interest rates, but they've locked in a lot of low interest mortgages and so forth. So it's not a pressing issue. It's not something that immediately causes a recession. It's a slow process. And I've been of the camp, I keep talking about this, that I felt like we were in a rolling recession where different industries would get hit at different times, right? And the market as a whole was not going to collapse or anything. It was just going to kind of hit different areas at different times because that's the way this is going to work. It's just going to be a drawn out process here. But I'm still a little bit more that this is going to have an effect. And I also think that the Fed is higher for longer. They're going to keep rates up much more. I mean, the markets earlier this year were pricing in rate cuts and all these things. I think that's ridiculous. The Fed is certainly in the higher for longer camp because I've used this analogy that I came up with of the golfer. The Fed's like the golfer that just tried to hit it over the water and plopped it in the water. Now they got to go back for more club. They just screwed up, right? They said inflation was transitory, so they have to hit it long. They have to make sure that they battle inflation, and they're not going to get it wrong twice. They're not going to cut rates too early and so forth. They're going to keep rates higher for longer than they even think they should because they're going to err on that side of not making the same screw up twice. They're already in the history books for an epic screw up. They don't want to make it worse. So I think all of these things will have an impact. It's not immediate. Fundamentals are slow. Those economic cycles, they take years. So if you're expecting the fundamentals to play out today, well, that's just not a good expectation. What I think is so interesting about today, and the reason I wanted to just come in and talk and discuss and analyze, is because what happened today with the news is really, whoops, where'd I go? Is really interesting. So look at this. If we go into, let's go back to our calendar and let's go to today and let's highlight this. This is a huge news story. We've been talking about this. Again, you're probably sick of it. We've been talking about this a lot. What's the news today? CPI. Huge drop. Went from 4% to 3%. If you're surprised, if you're shocked that that's happening, then you're not paying attention. See, the general public they're not following, right? They just hear, wow, inflation's down 1%. For the year, it's down to 3%. Oh, wow, great news. Let's go buy. And so they get sucked into that. But it's just not the way that markets work. It's not the way that you're going to make money. We knew that this was going to have a big drop. We guaranteed it, right? We didn't know how much. We didn't know the exacts, but we knew it was going to have a huge drop because last July was a 1.3% month over month number, and you were getting rid of that. If you're getting rid of 1.3% of your inflation and adding a bar that we knew was going to come in low, we didn't know if it would be 0.3, 0.4, 0.2, 0.1, but we knew it was going to come in much lower, you're going to have a 1% drop in inflation. It's just guaranteed to happen. So people buying on this news that, wow, this is such great news and so on, it's really kind of not the smart play. Now, here's the problem for the markets. Look at what happened. July last year was peak inflation. Look at the inflation numbers we just got rid of, but look at the ones that we're going into. They're much smaller. So you're noticing that inflation at 3%, it's going to be much harder to get inflation to do anything lower, to get it reduced from here. It's just a much bigger battle. The Fed's target is 2%. We might be at 3%, 2.8. It's going to be hard to get it down to their target. Now, it's not a disaster, perhaps, but you look at other things that show more core inflation, the PCE numbers, and so on. This CPI can always be somewhat manipulated, and it's not the best inflation gauge. The Fed has even said they prefer PCE, which shows a little bit more sticky inflation and such. So anyway, make a long story short, we absolutely knew this was coming, that we were going to get rid of this huge inflation number, that it was going to print a low. And sometimes the quote unquote good news is what? Well, it's actually the worst time to buy. Now, I don't know if that's the case here, but it sort of would be poetic if the literal drop in the markets started with the best drop in inflation, right? In essence, inflation, because you're getting rid of all these numbers, the trend of inflation is polar opposite to the SPY. If you were to chart out inflation, well, it's been trending like this with a big drop this month because we just lost a huge number. But now it's hard to get inflation any lower. So if you're charting inflation, inflation's not really going to continue to collapse here. Can the market just keep going on its own? It's sort of poetic, this inverse relationship. We thought that in this June to July area where the quote unquote good news came out was much more likely to be more of where the markets would top out. And that makes sense if you really understand something we teach, which is there's known knowns, there's known unknowns, and then there are unknown unknowns. And these are all very different things, right? The first column refers to whether the market knew it was coming out and when it was coming out and so on. Like, is there the date and the time and the expectation and so forth? Did we know it was coming? Secondly, what's the impact? So, what's an example of a known known? Well, there's plenty of them, but just use hypothetical. Let's say that you have a president who's extremely popular in his first term, and his approval rating is through the roof, and he's up for re-election. And this happens with like senators and so on, maybe not quite as much on the presidential side, but you just know he's going to win. All the polls show he's 99% probable to win, and every state loves him, whatever, right? Well, there would still be an election. We'd know the date and times and so forth. And then we would even know the outcome, right? We know he's going to win. So this is fully priced in. If you're buying when on this good news or bad news or whatever, it's just priced in. So don't expect, a big reaction. In fact, that's often a reversal that happens from that. It's buy the rumor, sell the news type of stuff. There can be known unknowns. lots of examples. CPI. The CPI that came out today was a known unknown. We knew it was coming out today at 8:30 a.m. Eastern Time. We knew the exact day and the exact time those numbers were going to be released. We didn't know the exact numbers, but guess what? We even knew most of that. We knew that there was going to be a huge drop. We knew that it was going to come in around zero point 0.3. We knew that the markets, in other words, the markets have already had such a chance to buy in anticipation of this, right? Any company reporting earnings, any economic results, any central bank meetings, they're scheduled. And usually they're well forecast. And so these are mostly priced in. Is it fully priced into the market, this drop in inflation? Maybe it's not completely, but it should be mostly. It's just not a surprise. If you're massively surprised that inflation dropped this morning, you just weren't paying attention, right, to the details. So this is where the public screws up big time. And the public would be buying on something like this. I usually want to think about what would the general public be doing that they're not really well informed. They're not paying attention to the details. They didn't know that CPI was going to drop. They don't even understand how to calculate it and so on. That it's the month over month cumulative and so on. So I think about how they think, right? And they would be buyers on this, which instinctively makes me think, okay, should be mostly priced in and they're rushing in to buy. Well, that's probably not the ideal spot. And then you have true unknown unknowns. Now, these are not priced in at all. And these can be good or bad. If you had cancer cured, wow, positive, right? Creation of the internet, maybe AI. These can all be good. You could have bad. You could have terrorist activity, natural disasters, whatever. Unknown unknowns have no date and time scheduled, and they have so many potential impacts. They're not priced in at all. Well, these could create massive, massive follow through. This is about the only time that buying on that good news or selling on that bad news will have follow through and will be the right decision. But most of the time you want to fade it. So the public looks at this and they say, well, this is good news, or this is good news, or this is good news. And I always say, don't think of news as good or bad, right? We can label what the public perceives it to be. But this is more of a sell signal. And this is more of a sell signal. And only this one would be more of a buy. In other words, likely to have follow through. So if this were gapping higher in the markets on a true unknown positive outcome, I would be fully on board. The fact that we're gapping up like this on something that's probably mostly priced in, the way I would teach this is if you have 3 charts, all identical, and you said, well, what's causing this stock or this currency or this market or whatever? It could be copper, it could be Bitcoin, it could be... I would run it through this and say, well, it was a known that's creating this big jump higher. Well, this is more of a sell. This will probably go down. Well, this was a known unknown. This should be mostly priced in. It's more of a sell. Probably going to fade off. This is an unknown and it's really positive. Okay, this one can have follow through. But that's it. 2 out of 3 times buying on the quote unquote good news would have been the wrong decision in essence, right? So this is where news catches people really off guard. You have to think about whether this is truly something that was not priced in already and can create that follow through effect and so forth. And you'll see it in a variety of different markets. We talked about this in crypto over the past few weeks. If you look at the crypto markets, here's Bitcoin. Bitcoin broke out here, but it broke out on some really good, sort of unknown unknowns type of thing. The markets were not, there was no scheduled appointment for some companies to announce that they were coming out with a new exchange. And these are big players. This is Schwab and Fidelity and so forth partnering to create a central exchange. This was not, there was not a date and a time. And then the crypto markets have to go, wow, well, what does this mean? Well, this means that there's, much better chance of stability, fewer fraudulent actors, et cetera, et cetera. We talked about it. That's an unknown unknown. There should be follow through. And boy, was there ever. Look at how the next few days went. Now you're consolidating, but even as you're up here, you're holding on to the gains. Okay, that's an unknown unknown. It was a positive one that came out, and of course the market took off. And just as we discussed that very day, that was an unknown positive, and it should be looked at that way, that there should be follow through to the upside. I think the CPI today is very, very different. So for me personally, I would say that I have been saying that I thought the markets were in an exhaustion phase, and they were. I mean, we haven't, from this kind of big signal of exhaustion, we haven't gone anywhere until today. Till today, we kind of broke out a little bit above that. So does that hurt my thesis? Well, again, the price action, but I've been on record as saying, where do we go in the short term? I don't know. I don't feel super confident. Well, now I frankly, I think I do, right? I got a little more aggressive here in thinking that the markets would stop going up. And I feel the same about today's price action, that I think this is a little bit more of a sucker's rally. It should be mostly priced in. It should be one of those known unknowns. So mostly priced in. Can it go up for another day or two or whatever? Maybe, but I just don't think this is the market that takes off from here. I'd be surprised personally, but again, we have to say the technicals so far are bullish. So I'm not sticking my neck out there. I'm not really doing much of anything today. I'm waiting for a pitch to swing at. If you look at this from the standpoint of my outlook, what would make me more negative, and I don't know that this will happen, but if you had some sort of shooting star or something like that, if you had, let's imagine that the market falls off of its highs and finishes with a red candle and a long upper shadow. If we were to draw this chart this way and it were to finish like that, then I'll leave today with some bearish setups, some bearish trade, whatever. Okay, I would be much more inclined, but I need a technical signal to act upon this outlook. And it's important to understand we're not perma bulls or perma bears or anything. I could even understand someone that just says, I trade the charts, and a lot of what we're talking about today is what Maverick refers to as cocktail talk, because it's fundamentals, and fundamentals are slow to change. And so if you think that just because we discussed this today, the market has to collapse tomorrow, this is not really how it works. We need the technicals to start to turn. You need to get some signals that the bulls are trapped, that there's a false breakout. And then all of a sudden, you can see from false moves come fast moves, because now you have some trapped bulls and some selling feeds on, and all of a sudden you can start to motor lower. Here you had that, and you had a nice tradable sell-off, and then I was on record. I thought what was going to transpire was more of an ABC type of deeper correction, and that hasn't happened. So I mentioned this to our stock and option group earlier this week, that you really have to be a buyer of the market for now, because give credit where credit is due. The market's held in, and it didn't ABC, so I'm just not surprised that in the short term we had this burst. But boy, there's something poetic about today potentially being more of the peak. Right around that CPI just makes so much sense from the way that I analyze and study markets. So interesting, I think, in terms of possibilities. Now, if we look at other currencies and we look at the bond market, the Japanese yen has been trading very similar to the bond market in that as rates have been going up, the yen has been going lower. Now, they are very, very indebted, for one. If you look at debt to GDP ratios, they're about twice as bad in Japan as anywhere else. So that's one factor. As rates have started to come down a little bit the past week, the yen has started to bounce. It's created a little bit of a bottoming point, but I haven't been doing much with the yen at all. I'm a little cautious against shorting, but we've talked about that back in here. I really think shorting made more sense because, again, we were bullish on markets. If you were shorting back in here, great. I don't think I'd want to short it any further for the past few weeks.
Would having more trading capital help you meet your trading goals? Maverick Currencies is the oldest US-based Forex and crypto prop firm. We fund traders just like you with 5- and 6-figure accounts where you keep 70 to 80% of profits. Click the apply link on the top right of this video to start the process. This will take you to a 4-minute video that explains the trader position, and you can read a list of FAQs that answer pretty much all the basic questions you have. After that, if you're interested, fill out an application, and then you'll watch the full-length recruiting video and schedule an interview with our recruiters. Are you our next trader?
US dollar. I think this one is a short. This one's really, really getting hammered today. A big drop. We had talked about yesterday, we did the RBNZ meeting, and we had talked about a possible long Kiwi USD, and then it kind of went the opposite of that initially on the announcement, but that would have been the home run trade. That would have been fantastic given the way that the yen has dropped. So that was certainly the right way to play the USD, which is what we were looking at. If you had taken that pairing, that would have been home run scenario. Swiss franc, bullish, just looks great. Recent breakout, multi-week, multi-month consolidation. Fantastic price action there. Euro, still more bullish than anything else, right? It's kind of had this rounded bottom here. It's pretty normal type of price action as we go back up towards those highs and such. So no problem there. British pound, not a great day. Really the reversal of fortunes. And this will be the biggest, ugliest bearish candle that's on the chart. I mean, look at all the rest. So I think this is a bad turn for the pound. I'd expect a small bounce, but this thing's going lower in the short term. Then we get to the risk-on currencies, CAD, Aussie, Kiwi, and they're all really more breaking down. I mean, 50-period moving average there in the CAD. I guess Aussie and Kiwi not breaking down today, but breaking down recently. Look at the downward phase. Kiwi, been in a little bit more of, we'll call that one sideways, but certainly has reversed nicely today. I don't know if I really have a strong opinion on that lower section. I would say pound's reversal to the downside looks pretty significant. I'd say euro and Swiss franc still look pretty darn good on the upside overall. US dollar still in that plummeting phase. And then Japanese yen, I'm not an aggressive buyer by any means, but I'd also be a little nervous to short as well. So anyhow, that's how I look at these markets. We've been on board with the long crypto trade since the big exchange announcement. And if we look at crypto as a basket, this looks like a buying opportunity, just a standard bull pullback. If you look under any of these, Bitcoin, Bitcoin Cash, Ethereum, Litecoin, they're all pretty similar in that we had the breakout. Now we've pulled back, and this is where the rubber meets the road. This is where they should bounce. If they don't bounce here, well, then that opens up the possibility of for sure sideways price action, maybe worse, but it wouldn't be bullish. Obviously, this is where they really across the board, all of them show that this is the spot where they should be bouncing and should start to rally from here. So if you are more along the lines of looking at alternative, these have looked so much better than gold. I mean, it's just not in the same ballpark. But gold, with today's huge US dollar deterioration, gold has broken out to the upside above a steeper downtrend line. It's really interesting, the follow through here. If you look at the pieces, so why is US dollar down so much on this CPI? Well, I suppose, I mean, it seems like a bit of an reaction to the CPI itself, right? That inflation came in and dropped a lot. So maybe they start going, oh, the Fed doesn't have to raise rates as much and be as aggressive. And maybe the US dollar was pricing in more rate hikes. And now they think that that's not going to happen. I don't know. That would be kind of the reaction to the news. Well, certainly gold is the antithesis of this. It tends to move inverse relationship. So big down move in US dollar to the tune of over 1%. Big up move in gold to the tune of over 1%. So moving opposite to each other. That would be a little bit of a negative for the crypto markets in that you're not really seeing much. They're sideways on the day. Even Bitcoin slightly lower on the day. Given the big move down in US dollar, if I was to just say to you, hey, US dollar's having a gigantic drop today, what's Bitcoin doing? Think about this in terms of this is the way I like to think about things, like quiz yourself. Okay, US dollar's down big. What's gold doing? Well, it should be up big. It is. What's Bitcoin doing? Well, you certainly wouldn't say down 0.5%. You'd say, wow, US dollar's down big. Bitcoin's having a great day. Crypto's having a stellar day. That's not happening. So it is a little worrying. I mean, certainly bad price action on something that quote unquote should have been good for the currencies, right? Those cryptos. That's a market tell. It's just a 1-day event, but today's just important. It is. I can't emphasize it enough. The things that are happening in the markets today, we're going to look back on, I think, and kind of say, okay, this was an interesting turning point for a variety of different markets. I think it's where gold has essentially stopped its downtrend. I think it's where US dollar has started its deterioration. I worry that the equity markets are at a peak, and we're going to fast forward a few months and talk about how the markets turned right around that CPI and some of these false moves higher and so forth. So I worry that that's the case. We'll see. We'll see if that's right. But I feel like today is a day that's not like most days. We'll put it that way. All right. Well, hope you enjoyed today's midweek. A lot to discuss in a variety of different markets. A lot of things moving big. The bond market rebounding, rates coming down sharply, dollar tanking. There's just a lot going on. But I would say most roads lead to everything that's happening today is much more of a risk off than a risk on. The equity market notwithstanding, stocks are showing it a little different, but I think it's a little bit worse for the markets, oddly, that this has happened. It's fully priced in, perhaps. Maybe that's why some of these changes are taking place. Have a great rest of your week, and we'll see you next time. Goodbye, everyone.